Welcome back to the mini course. We took a look at what a successful week might look like last time, where a trader using just $3,000 margin per contract could have made over $2,700 trading just one lot. It's a big gain made from capturing relatively small moves, and it shows the power of leverage when used correctly. Now, leverage has the positive effect of magnifying the gains, but there's also a double-edged sword. Leverage can magnify the potential losses. And so when we trade this way, it's a high reward, high risk arena. And that means that the key to success here is timing. So the topic for this second lesson is going to be how to be right now. Remember, in the last lesson, we talked about the conventional investor who might be willing to endure some pain before seeing gains. In other words, investors are willing to hold through some drawdown before they see their profit. Now, the drawdown refers to the peak to trough decline in the position. We can see a few drawdowns here on the chart where we see the high made and then prices are pulling back. Drawdown doesn't always refer to a deep pullback, but the ones that we're concerned with really are where prices are dipping more than 5%. And as we can see here on the chart, they're not completely uncommon. And once the prices get down there, it can take several weeks or months even to recover. If we take a look at the smallest dip here on the chart, we can see how a trader would be doing something completely different from the conventional investor. Since the losses here on the chart would be magnified, trying to hold through a dip like this can wipe out the trader's account. Looking at the move, this is a $6,000 per contract decline in the price. So for a trader, traders want to be in and out. They want to be getting into a position and they want to be right away. In fact, for a trader, it's not just about getting out of the losing side, but it's also that the sooner that we can get out of a losing position, the sooner that we can put on the next trade. That's where trade setups come into play. Trade setups try to answer the core questions. Is the market going to go up or down? Where we also expect validation of the trade idea right away. And number 3, if we don't get the move we expect, what signals us to get out? Trade setups should be systematic and repeatable. And for us, trade setups want to be based on price because all the information about an asset is consolidated into the price. Even factors that are impossible to know, like market expectation and insider information. Our favorite trade setup involves buying or selling with the trend on a pullback. Now let's break down what that means. The first part, buying or selling with the trend, refers to the market direction. The trend direction we can see on the charts. Prices can trade higher, they can trade lower. These are both trends. They're opportunities to profit by buying long or selling short. The rest of the time we can think of as noise. The market is unclear of the direction, and most of the time the price action is very limited. If the market's not going anywhere, then you can't make money by trading. But if there is a trend direction, we can profit by recognizing the trend early and then sticking with it. That's the important part. Trading with the trend gives you a shot at big winners and puts the probabilities in your favor. And that's why we say that the trend is your friend. Now, for the second part, buying or selling on a pullback, we can see that even when there is a trend direction, prices don't go up or down in a straight line. Here, for example, we have prices going up from point A to point B, but there are pullbacks along the way. If we're able to get in at a lower price, it's a better price. That part goes without saying. Same with this example, where prices are going down, and if we're able to sell short at a higher price, that's also a more favorable price. So the question then is, how do we know if the prices are pulling back or if they're actually reversing? Here's an example where the price action looks almost the same. Prices are going up and then they're pulling back. But if we take a look at what happens after, we can see that prices are actually reversing. So what we want to know during the pullback as it's forming is how far is too far. With the trade setup, we can manage the position with a stop order, letting the broker know to get us out of a position if the price crosses a certain point. Managing the position based on the price allows us to have limited risk, and by entering a new position when the price is close to the stop already allows us to have low risk when we enter a new position. There's even the added benefit that by entering at the pullback, we have a high probability of actually starting the position off in the right direction, and that's where we get the chance to be right now. The takeaway for this call is if we can correctly identify the trend direction and enter at the pullbacks, we have a shot at catching a big move when the trend follows through, and if it fails to continue, we have limited or lower risk. This trade setup works so well, we call it the sweet spot, and identifying or learning how to identify the sweet spot is going to be the large part of what we cover in the rest of the course. You'll learn how the sweet spot is a moving target, but using a systematic approach, your computer can show you where the sweet spot is so you can hit it every time.